What do treasury bills, gold, the Fed, and ongoing de-dollarization efforts have in common? More than you might think. In today's episode, we're going to connect the dots and give you a high-level overview of recent events and how those things all impact the price of gold. Welcome back. Now, before we begin, please take a moment to like and subscribe to support the channel. Thank you. By the end of this video, you should have some deeper insights into the reasons behind gold's price movements, as well as insights into the macro environment that's setting the stage for future economic and government policies to take shape over the course of the next several months and potentially years. Now, some quick background information so we're all on the same page. Gold has had a lot of ups and downs throughout 2023, and as we prepare this video today, it's currently sitting very close to all-time highs at 2,060 per troy ounce. We've had a couple of lows throughout the year where gold dropped below 1,850 per troy ounce. In mid-March, the price of gold skyrocketed thanks to the collapse of Silicon Valley Bank on March 6th. Following that surge in demand, gold hit a ceiling and dropped again when demand began to taper. Now, throughout the year, we've had ups and downs as investors gained confidence that rate hikes would be stopping, only for that confidence to be shattered as the Fed continued to raise rates, depressing the price of gold. Now, when considering financial investments, gold is thought of as a safe haven, and so are treasury bills. Once the government approved the budget earlier this year, new debt could be issued, and that debt takes the form of T-bills. Now, T-bills have one big advantage over gold, and that is that they have a yield. So T-bills have been very attractive to investors lately because the yield has been uncharacteristically high. And in fact, we had an inverted yield curve appear last year on July 5th, 2022. Now, the inverted yield curve just means that under normal conditions, 10-year T-bill has a higher yield than a 2-year, which has a higher yield than 6 months, and so on. But the yield curve between the 2-year and the 10-year inverted, which meant the 2-year had better yields than the 10-year. Now, this is a recession indicator, and it generally appears something like 18 to 24 months prior to a recession starting. But the important thing is that people could make more money on a 6-month T-bill than they've been able to for the past 10 years. So, as the Fed has raised rates, it's made T-bills a more attractive option for safe haven investors, while making gold less attractive. While we've had crises like war and banking collapses to buoy gold demand, we've also had actions by the Federal Reserve dampening gold demand. And whenever someone from the Fed says something even slightly dovish, traders have gotten excited, started buying gold futures, bumping the price of gold up again. Now, if you're following along so far, great, we're going to add another layer. T-bills are just government bonds, and with bonds, the value of the bond drops as the yield increases and vice versa. So as rates have gone up, the T-bill yield has increased, but demand for bonds is also down. The two big purchasers of U.S. debt were actually China and Japan. Neither of them are buying right now. And when you hear about foreign countries buying U.S. debt, they're talking about buying treasuries. Since 2018, China's U.S. debt holdings have been declining. And if you've been following along with the news, China is rallying the world around de-dollarization. They're trying to get the world to stop trading in U.S. dollar as the world's reserve currency. As we're attempting to take on more debt than we ever have before, China's holding up their hands and saying, "Not this time, buddy." They're not buying. Now, whether that's due to de-dollarization or because of some other factors, it's hard to say. Japan is a close ally, and they're not buying either. Domestic holders of U.S. debt, like the Federal Reserve, are not coming through right now. The Fed doesn't buy treasuries directly, but if they're buying in the secondary market, it's creating demand all the same. Right now, the Federal Reserve is trying to reduce its balance sheet. So a reduction in demand for bonds does what to yields? Typically makes the yield go up. If you have to increase the yield to make it attractive enough to buy. So going back to gold, with treasuries as a safe haven asset that also has a substantial yield, it's no wonder that gold demand has not been as strong as it could have been. Sure, the central banks are still buying, but the World Gold Council reported that in Q3 2023, central bank gold buying slowed down. It's still 8% ahead of its 5-year average, and we think that's reflected in the spot price. So while watching treasuries closely, on November 29th, and this is recent news, we saw a couple things happen. First, the yield on 2-year treasuries suddenly dropped by 8.9 basis points. Bill Ackman, celebrity hedge fund manager, predicted that the first rate cut would be coming in Q1 2024. We also saw some dovish statements from Christopher Waller, one of the Federal Reserve member board of the governors. The markets are always forward-looking, and a dovish statement can cause markets to move. However, this T reading has happened many times in the past, with investors caught on the wrong side of an irrationally exuberant trade. What Waller actually said was, if the decline in inflation continues for several more months, 3 months, 4 months, 5 months, we could start lowering the policy rate just because inflation is lower. It has nothing to do with trying to save the economy. It is consistent with every policy rule. There is no reason to say we will keep it really high. But he also said, inflation is still too high, and it is too early to say whether the slowing we are seeing will be sustained. And he also said, there is still significant uncertainty about the pace of future activity, and so I cannot say for sure whether the Federal Open Market Committee has done enough to achieve price stability. Now, we haven't heard from Powell at this time, and Waller put a bunch of caveats to what he said. Nevertheless, it was enough to slash treasury yields, and we simultaneously saw money pile into gold. What does this tell us? Well, it helps to confirm the idea that a tug of war between gold and treasuries is ongoing. If rates start to come down next year, we expect that would breathe some life into gold prices, and we might see things start to take off. But remember that we have historically low demand for treasuries. The bear market that treasuries have been in is somewhere between the dot-com bomb and the global financial crisis. If demand for U.S. debt stays low and our traditional buyers don't return to the table, whether due to de-dollarization or some other reason, we may see persistently high yields that split demand for safe haven investments between gold and treasuries. That's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching. We'll see you next time.